All right, guys. So welcome to the 12th day of this YouTube training. Um, if you have not gone through the last videos, do want to go through the October 2024 mentorship playlist. All right, that is where you're going to see all the videos from day one up until this particular day, which is day 12. All right, so all videos are in the playlist, and I encourage you to watch them now. They are still available because they may not be available forever, right? So do I just go through them at least two times each one so that you get a better understanding of what is being said. All right. All right. So today we're going to continue with our time and price series. So yesterday we talked about the ICT London Q zone, right? I told you guys that one of the most important things or one of the most important elements when it comes to trading is time. Now, I told you guys yesterday that time is very important because it lets you know when there will be liquidity in the market. It lets you know when to enter a trade and the pairs you should be focused on, right? There's no point, just trading every single time. You have to have a specific time that you expect the market to be volatile, right? You want to be trading when the market is volatile because the market is moving when it's volatile, right? The market is moving when there's liquidity in it, right? So you want to be in the market when there's activity going on, right? So we want to be trading the pairs that have activity going on at that particular time period, right? So that is why we focus on time. We have time component of trading. We have kill zones, we have midnight open, and all those time reference points, right? It makes it easier for you to navigate, right? And now something that I need to point out is that regardless of all these things just help you to frame better trades, right? But it does not make you immune to losses, right? The reason is that there are things that are beyond the charts that can negate your trading analysis. For instance, maybe you plan to buy a particular pair, and that pair you were not aware that there was a fundamental event, maybe an earthquake, a WAR event, or maybe a policy just came up, maybe the president, gave a new policy or something of that sort. The bank came up with a new strategy that you're not aware about, right? And then it negates your trade analysis. So technical analysis is not void of losses, right? You have to also give room for losses. And the way you give room for losses is by what? Managing your risk and thinking in probabilities, right? If if this happens, then I do this. If this happens, then I do that. So I should always give room for mistakes, give room for losses, give room for unexpected outcome, right? Some things you don't expect. Just give room for uncertainties, right? That's why you should manage your risk, right? Don't put all your money in one trade or at once, right? So always diversify. If you have two brokers, put your account in your funds in two different brokers, trade your accounts differently. Always make sure that you give room for things going bad, right? Because trading is a risky endeavor. So you always have to do what? Be cautious, right? So that is basically what I have to say. So all these things I'm teaching you here doesn't mean you won't take losses. And because you took a loss doesn't mean you should abandon your system, right? This is what a lot of you do. So if you guys are watching this video because you have abandoned your previous system, so if you guys, after watching this video now, you go and try it for maybe 1 week or 2 weeks. When you start taking maybe two or three losses, you abandon this one, move to the next thing. And that is not how to trade. Right? If you want to see consistency in trading, you must stay long enough for that idea to become what a second nature to you. Right? The same way you can walk to a place even while pressing your phone. You're not even looking at the road because you're familiar with the place. If you go to a familiar road now, and you can even be pressing your phone, making a call, and you still get there, right? Without even paying attention to what you're doing. So there's a way you can master your trading strategy, and it becomes a subconscious thing. Things something you can do even without putting too much effort, right? So that is what you want to do. You want to make sure that you understand your strategy until the point it becomes a second nature to you. Just see it. You don't need any other thing, right? And then finally, um, you have to put in the work, right? Put in the work to back test. I saw someone that was asking me that I should hold a live session. I don't understand. I'm teaching you for free and you're telling me to hold a live session again for you. I don't really understand what you mean by that because this class is for free, right? So this is my own part of just educating you. So you have to do your own part by doing what? Going to back test. I won't back test for you, right? So I'm not holding any live session, right? What he meant that I should hold a live trading session, like I will be on trading and be showing him, I don't have time for that. right? All I can do is teach. I don't do live trading sessions. Right, I don't do that. So I'm teaching you for free. All you have to do is back test, right? Just back test. You get it like that, right? That is it. So let's talk about the ICT power of three, right? And I told you guys that this power of three refers to three things, right? So the power of three, right? The power of three, so ICT calls it. I learned from the ICT. So the first part of the three component is what? The accumulation. So we have three components that makes up the power of three, right? The accumulation. What is next? The manipulation, right? And then what is next? The last part, which is what the third part, which is called the distribution. Now, this is a three component or three part component of time, which states that the market undergoes three cycles or three phases. The first phase is accumulation, the second phase is the manipulation, and the third phase is the distribution. And this occurs almost every day, right? It occurs almost every day. Now, what this implies is that whenever the market has bullish intent, right? When the market is accumulating buys, like the market is accumulating buys now, maybe in this box here, the market is accumulating buys, right? There's an accumulation of buys, of buy orders. Now, that is the first thing the market does. Now, the market starts to consolidate around there, meaning that is in the phase of accumulation, right? Market accumulating buy orders, right? Now, what happens next is what the market does gives is what manipulation. Manipulation means that it goes what in the wrong direction, right? It's something like this. Market will drop down, so making people to think that it wants to drop. So this second phase, what we call what the manipulation, right? So we can call this false move the manipulation, and then what? Lastly, the market does what? Moves above. Right. So now this is the three-stage component of the power of three. When the market is bullish, not always, but most often or usually or on a classic buy profile, the market accumulates buys, runs, stops. This run of stops is what we call what? The manipulation. And then the overall move to the this original move is what we call what? The distribution. So the market accumulates positions, then manipulates to take out those that are entering early. So people might see this and they might be buying. Maybe they are buying at this level here. They'll say, okay, this is a support level, right? They will be clicking buy. As the market tap here, 1, 2, 3, they will be clicking buy here. The market does what? Weaks them out and then what? Reverses completely. So this is what we refer to as the power of three. So always anticipate that the market will give what a manipulative leg before they what moving its overall direction. Now, this whole thing can be broken down what to the candle perspective. Now, for every single candle you see, every single candle has what a body and a body, an upper wick, and what a lower wick. This is how every candle looks like. Right? Every candle. So now, this is what the candle looks like, right? So now, what do we do with this information? Now, have you noticed that when the market is bullish, right, the market tends to do what? Go down. Just this thing I explained now. When the market is bullish, I've noticed that a bullish candle usually goes down first before going up. Let us examine it. Now, look at this. Let's look at bullish candles here. Can you see this bullish candle? What happened? Can you see how the market went down first? Clear these tops, right? That's what I will just explain to you guys here. Can you see it? Clear this top and then what? Pushed higher. Now let's look at the next candle, which is what? This other one. See the market opened, ran below, and then what? Pushed above, right? So that means that most of the bullish candles have the same signature move. It opens, goes down first before going up. 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 This is what we mean. This is the nature of price. Of course, some candles might not do the same thing, but on I told you guys that this is what happens often, not always, right? So we want to trade when with something that happens often. That means if we are bullish, right, we want to see price run below before going higher, right? That is the whole concept of the power of three or accumulation, manipulation, and distribution. So the whole idea is that the market gives a manipulative leg before going what is original direction. Now we use the daily candle to spot the power of three. right? So use the daily candle to spot it. Now, we transpose the daily candle to a lower time frame to transpose this whole thing. So what I mean is that this is a daily candle. So I look at now on the lower time frame. What do we do on the lower time frame? We mark the open of the candle with the New York time, right? This is the power of three. Now I'm explaining it, I'm just breaking it down. Right. Someone was asking me about the midnight open candle. This is it. So we mark, okay, as well as market was ranging, just playing around, and then we now enter a new day. So we simply bring out the line and mark what the beginning of a new day. So this black line is the beginning of a new day. And we use what? The time zone of New York, right? Don't use your local time. Use what? The New York time. This is New York time at the top right here. So you come to New York time and select it. So you use the correct New York time. So now what we mean that when we are bullish, price, when the market opens here, it should go below what? This low. Or yeah, it should go below this low that was formed before the midnight, and then what? Give its manipulation. So can I call this what? We cannot call this whole move what? The manipulate, the accumulation. Now, this push down, can I call it what? The um the what? Manipulation, and then the market is not ready to, market are going to give some kind of bullish break. Right. Now, this is what we now call the distribution. We now have what? The distribution. So this is the power of three. The first element is what? The accumulation of orders, which is usually a consolidation. Second one is what? The run, the force run, which is what we call the manipulation. And then the final move is what we call what? The distribution. Right. So this is what we call a classic buy profile. Right. This is a classic buy profile. It's a classic buy profile. Right. So now let's talk about a classic sell profile. So it's still the same thing for a classic sell profile. So classic sell profile is still the same thing. So we see that market will do something, and then by midnight to run above, give us some kind of bearish shift, and then what? Run down, right? So this is what we call a classic sell profile, right? So we mark the manipulative leg, this manipulative move, and then what? This is what? The distributive move. This is a distribution, right? So this is what they refer to as what? The power of three, right? And so refer to as what? The power of three, right? This is what we refer to as the power of three, right? so that is it. So this is just so remember that you must mark what the midnight time, right? So you mark the midnight time, where that's where you start marking from. You mark the midnight time, where the midnight candle begins, right? You now mark it, right? And then you do this. Now let us look at a classic example of this, just for you guys to have a better understanding and feel for what we're doing here, right? Or let me just leave that on the screen so that in case you need this in the future, right? So this is what we mean. Now let's look at the market that is very bullish, right? Or let's look at a trending day. I want to look at a day that was very clean and trending. All right. So this is it. So look at a very clean example here. The market was in a kind of consolidation from here. Look at this. Where we kind of played around this zone here. Can you see that market was consolidating? All right. From here, you can see the market has been going up and down. And not only that, pay attention to this. So now there was a kind of resistance level that was formed there. You can see the first bounce, second bounce, third bounce, and then the market finally breached through. So now you can see the market was kind of what giving what a conversation around here, right? Now what happened in the New York time? So this is the beginning of a new day. This is 12 o'clock New York time. This is 12 o'clock. So what happened? AM. Can you see what I'm referring to? Can you see how price pushed above, right? Blowing out what this Asian high. Remember, this high that was formed in Asia. So remember, this blue line is what we call London kill zone. So remember the previous class, I told you guys about London kill zones, right? So you can see a market made a consolidation here, pushed above, and then what? Can you see the market what? Dropped to the ground, right? Taking out this low, and finally, I think if you take out this low, let me see. Let's see. So can I know? Sorry. Yeah, I did. So can you see a very clear example of what I mean? So you have the market do this midnight candle, pushes above and then what? Push down, right? So that's a very classic example of of what I'm talking about, right? So look at this example now. Another example here. So market in this case here, market wanted to go bullish, right? That was market was trying to go bullish. So what they did there? We had our Asian range here. I told you guys about Asian range. I think I don't know when I was talking about liquidity, talking about Asian range and all of that, right? So we have our midnight open here, somewhere around there, right? Midnight open. So what happened next? Can you see our price did what? Ran below and then was bought, right? To take out what? This high here. So if you bought down there, I'm targeting this high to take profits, right? This high, this last recent high. So you can say Mega did that and then pushed above, right? There was news here, so you cannot really classify this because anytime we have a news events makes the market to go crazy. So there was news event here. Normally, the market should have pushed above this high. Since it was done to drop, market should have gone above at least this Asian range, but it didn't do that. It was, that's one of those days that it doesn't play that. Because this is the midnight candle there. Market actually went above it and dropped. But would have loved to see price take out this, this. Now, the reason why price didn't take out this is because there was already what a liquidity run here. So market already ran liquidity here. So market did not see the need to run on that liquidity. So that was the reason why this held. So you can see this other block here, right? So for me, I don't really trust Asia other blocks. But the reason why this held is because the one that was news. News does not really respect, technical analysis. And they already ran liquidity here. So news was make price to tap there and then. So that's what happened. So this was the case of this example. But look at where the middle candle was. Can you see it actually gave what? The manipulative leg before they was dropping down. Right. So let's look at one last example. All right. So this one was just a classic bearish market, but there was nothing very good clear here. Right. It was also really clear here. Right. So normally we would have loved to see price, reject from here, push above, but that did not happen. The price pushed below, came back, tapped into this last up candle here, right? Before going down. So this was a case where you'd have loved to stay out. Because for me personally, I don't like to take trades where Asian high is clean or Asian high is left untouched. Right. So I don't like this kind of trades. Right? This kind of trade would have been a no-no for me. I like to see price clear this Asian range high before taking my trades, right? I don't really like trades here. This is a very clean example again. So can you see market was bearish? We see our lower high, our lower low. So we can see this little consolidation here. Markets went down first. That's not what we're looking for. Looking for what is sell. Since market is bearish from this high down to this low. Market is bearish from this swing high down to this swing low. So we're not looking for buys. So market ran below. That's fine. Market still came above. Right, this is what we wanted to see. Markets came above, took out this Asian range, blew this, and then tap into this key level here. Following what dropping down to the ground, right? So these things happen on repeats, right? They happen on repeats. Look at this example again. Can I see how price want to sell? What happened? We had from this was a bench market from this swing high to this swing low. Market did what? Run above what? This Asian high. Can you see this little can let's zoom it so you can see it very clearly. So market run above this Asian high. Can you see this little push up and then will drop down? So this was very clear example of what I mean by Asian, power of three. So you can see how these things play out on repeat. All right. So remember what I told you guys for a classic buy day, the market should go down and then do this. For a sell day, should do this. Now this is for a classic one, right? So there are cases where price doesn't go above Asian high. Like now, in the example I mentioned, the price went below what this Asian range low. But sometimes it doesn't do that. Sometimes it just goes below midnight candle, maybe tapping into something. So be mindful of that too. Sometimes price doesn't necessarily need to take an Asian low. Sometimes if there was already maybe this session, maybe this already happened in Asian session, right? Maybe this already happened in Asian session. Market already took out this low in Asian session. So price might not want to go down again. Price might also reverse from here. Price might not choose to reverse from this point here, right? Price might do something like this. We just choose to reverse from here. Can choose to reverse from this point. Since we already took out was Asian low with this. So since we already saw a takeout of Asian low, price can still choose to do this. It's now reverse from this other block here and then move higher. So but the most important thing is that price should go below first. If you're bullish, wait for price to go down below what? The midnight open. If you're bearish, wait for price to go up above what? The midnight open. So that is the most important thing. So Asian range is not that important when there's already a liquidity takeout in the Asian session. So if Asia already took out liquidity, there's no point for market to still take out liquidity again. So in the cases where we want to see this happen is when market is what's in the range. Market is in the range. They want to see what this taken out. Maybe it's the kind of box, something like this. But there's a very clear run on liquidity in Asian session. Market might not really come down again to take out that Asian low again. It might also run above. All right, so that's basically what I want to point out. So your assignment is just to look. I showed you guys bearish examples. So show me bullish examples. So show me like two. Okay, let's do this way. So show me two bullish examples and two bearish examples. So let us see if you understand what I'm talking about. So two bullish and two bearish examples, right? An example when market did it gave a classic buy and a classic sell. So look for two. So remember I told you guys this is a classic buy, this is a classic sell. So show me two for classic buy and show me two for classic sell. So sell is bearish, while buy is bullish. So show me two for classic buy, show me two for classic sell. So that is basically your assignment for this class. So I hope to see you guys in tomorrow's lecture. Do want to like this video, subscribe to the channel, and I'll see you guys when I see you guys. Have a wonderful day. Cheers and God bless.